Good morning and good afternoon, everyone. Thank you for joining us for our excise webinar today entitled Fuel Tax 101. My name is Tom Patouche, and I'm a Senior Manager on the Customer Marketing team here at Avalara. Joining me today is Johnny Huynh. Johnny Huynh is a consulting service line leader at Kelly S Matthews LLC, a motor fuels tax compliance and consulting firm. Johnny has nearly 10 years of experience in motor fuels taxation and has helped clients of varying sizes across or address licensing, imposition, and reporting issues at both the federal and state level. Before we get started, I'd like to cover a few housekeeping items. Your lines are muted. Please use the Q&A box located on the webinar interface to submit any questions you may have during the webinar. At the end of the session, I will moderate the questions with Johnny and answer any questions you may have submitted. Our session today is being recorded, and a link to the recording will be sent to you via email in the next day or so. With that, it's time to get started. It is my pleasure now to turn the mic over to Johnny Huynh.
All right, thank you for that introduction, Tom. Good morning and good afternoon to everyone that was able to join us today. The topic today is Fuel Tax 101, and I really look forward to using my experience to give you an overview of some of the general concepts related to motor fuels tax. Around this time of year, I always get asked by a lot of people, are you in busy season? And they're usually thinking about that once a year, April 15th deadline for income tax purposes. But what some of you may know, motor fuels tax is typically a monthly return and tax that is due to the jurisdiction, and it's a return that requires individual transaction level reporting every single month. And so there are different complexities involved in the different jurisdictions that you do business in. And so today, what we'll do is we will give you an overview of some of those concepts and complexity through 4 different discussion areas. And that's going to be, we'll walk through the different motor fuels tax types. We'll talk about tax imposition points. That's, depending on what state you're in, how does that state impose the tax? We'll talk about what products are taxable. And then to close out, we'll talk briefly about exemptions, licensing, and reporting to give you a feel for the different requirements. If you already work in motor fuels tax, I hope that you'll find these concepts will help you make new connections or reinforce your understanding. And if you don't already deal with motor fuels tax in your day-to-day work, hopefully you'll find today's discussion interesting and that there's like this specialty tax type out there. So with that, we'll go into our first topic for motor fuels tax types. We typically use motor fuels tax as an umbrella term to mean 3 main categories of taxes. Those are, again, using the term motor fuels tax, inspection fees, and environmental fees. These are all volume-based taxes that are imposed on a per gallon or per barrel basis. And in addition to these 3 main categories, you may also see a gross receipts tax or a prepaid sales tax, depending on what jurisdiction you're in. So when we think of gross receipts and sales tax, those are usually taxes that are assessed based on the value of a product or service. But in the case that I'm referring to here, there are some exceptions in some jurisdictions where the gross receipts tax or the prepaid sales tax is actually also based on the volume of a product. And so depending on the state again, you may have to lump those into what you look at. For purposes of today's discussion, we're going to be focusing on the 3 main categories that I shared earlier: motor fuels tax, inspection fee, and environmental fees. So why are motor fuels taxed to begin with? So you may have remembered seeing this in the Avalara announcement for this webinar session. In general, motor fuels tax is collected to repair the roads and highways. As end users, you and me, when we pump gas into our cars, diesel into our trucks, and drive on the roads and highways, there's wear and tear on there, and so we are paying this tax to allow the government to maintain those roads and highways for our use. For the second type of motor fuels tax, under the umbrella, we've got inspection fees, and these are collected to fund quality product quality inspection. In some cases, they fund diesel inspections, and we'll get to that a little bit later in the presentation. And then lastly, we've got the group referred to as environmental fees, and these are collected to fund spill cleanup. Actually, this type of fee made the news recently. At the federal level, the oil spill tax was set to expire at the end of 2017, and it was basically off and not collected for a couple of months, but it was then extended by Congress, and it came back on and was effective again starting March 1st. And so that's an example of an environmental fee at the federal level that would pay for spills similar to the Deepwater Horizon oil spill. So who imposes these motor fuels tax? Generally speaking, the motor fuels tax is imposed at the federal, the state, and the local level, and all states impose a motor fuels tax. For the inspection fee, we typically only see that at the state level. For environmental fees, we'll see that at the federal and the state level. And one thing to note here is that only some of the states impose the inspection or the environmental fees. So again, depending on what state you're doing business in, you've got to look at what those requirements are, because there's potentially a registration and a reporting requirement. A little bit of information here on to give you a feel for what the tax rates are under these three main categories. For motor fuels tax, these are going to be on your traditional refined petroleum products, generally gasoline, diesel, jet fuel, basically products that run a car, a truck, or an airplane. And these rates range anywhere from around 7 cents per gallon to over 37.5 cents per gallon at the state level. At the federal level, they range between roughly 18.4 cents per gallon to 24.4 cents per gallon. For inspection fee, these are the fees are a lot. The rate is a lot smaller than what you see at the motor fuels tax category. These fees are typically either included as a separate line that calculates the fee on the motor fuel return, or we see in some instances where there's an entirely separate return that you file for the fee. And unlike motor fuels tax, which is generally on the more traditional refined products that can run a car or a plane, these are on a broader base of products. And it can include dyed diesel, even though dyed diesel is not used on the road. Like I shared with you, the rates are low. It ranges between 1 and 2 cents per gallon. For environmental fees, similar to inspection fees, these are typically on a broader base of products as well, and are sometimes imposed on the category of petroleum products, which, as you can probably imagine, includes a whole host of products that can come from crude. Similar to inspection fees, these rates are also fairly low, and they range anywhere between 1 to 3 cents per gallon. So in the motor fuels tax world, physical movement is really key to understanding how the tax is imposed and when it's imposed. Motor fuels tax is a transactional tax, and so we need to understand each transaction that occurs throughout the month. And to do that, we need to understand where the transaction takes place. And so what is the origin state? What is the destination state? If it's being exported or imported. We need to understand the mode of transportation that's being used to move the product. And it's also important to understand where title transfers between the buyers and the sellers. And understanding the physical movement of fuel within the U.S. is really the starting point for motor fuels tax reporting. So to kick off the discussion there, we're going to talk briefly about the distribution of fuel in the U.S. since physical movement is so important. So we'll talk about the common production, storage, and transportation assets that we typically come across in motor fuels tax. So we start with refineries who process crude oil to produce a variety of petroleum products. So geographically, the refineries in the U.S. are generally concentrated along the West Coast, kind of in the South along the Gulf Coast, some of the Midwest, and the upper Northeast Coast. So that's where your product is being produced, kind of along the edges of the country. There are pipeline systems that connect those refineries to storage terminals, and there are, many, many more terminals throughout the country. I think there's over 11 or 1,200 that are registered with the IRS as IRS registered terminals. And so that the pipeline system helps spread the product out and distribute the product. Since the refineries are along the coast mostly, you've also got vessels that can help you move quantities of, bulk quantities of fuel to other storage locations. So we got product at the refineries, moved by pipeline or vessel to the different terminals. And then from the terminals, typically there's a terminal rack, which is a mechanism used to disperse the product into smaller quantities onto trucks and rail cars that then take them to different service stations or perhaps move them to other types of storage facilities. For those of you who are visual learners like me, I always appreciate a picture. And so what I've got on screen here is just a visual of the different facilities and the mode of transport that we just talked about, kind of how fuel moves from refinery to terminal to service station. So I'll pause just for a moment so you can see the flow between the different assets there. To continue this discussion of physical movement, I'm going to put the facilities and the modes of transport that we just saw and talked about in a slightly different context. On the screen, you see two boxes, one for below the rack and the other for above the rack. Dividing these two boxes is a dark bold arrow, and this represents the rack that I mentioned earlier, which is, generally speaking, a mechanism to disperse product into a truck or a rail car. And why this is important is it's the basis for one of the most common ways that tax is imposed that we're going to be talking in just a moment here. And so it'll be good for you to keep this picture in your mind, what's above the rack and what's below the rack. And for those of you who have not seen an actual rack at a terminal or at a refinery, just picture if you're pumping gas the next time, when there's a car wash in the back and you can pay for the car wash when you pump gas, you take a code that you drive around to the back and you drive under that structure, and there's all the brush, the hosing, the water. A rack is similar in concept where a truck will drive under this structure that allows it to hook on to the piping, that allows it to pull product from the terminal or the refinery that it's at. So that's what you want to picture as a rack. And when we say below or above the rack is because a truck or rail car can pull up under that rack to pull product. And then usually everything else is above the rack because it's before the point that product is able to get into a truck or a rail car. Now that we understand the three main categories of volume-based motor fuels taxes, those were motor fuels tax, inspection fees, and environmental fees, and we understand the physical movement of product flow through the U.S., we're ready now to review the tax imposition points. And before we get there, you might be asking, why is it important for you to understand the imposition there? And really, it's so that it doesn't impact your bottom line. We often hear that motor fuels tax is just a pass-through. So that is true if you actually pass on the tax and you pass it on appropriately. If you don't do so, it can impact your bottom line and it would be an expense to the company. And so it's important to make sure we understand how it's imposed and how we can recover it on our subsequent transactions. And we do that. There are 4 ways to tax, which we'll go through next. So the 4 ways to tax, or the 4 main tax imposition points, are the rack tax, which is also known as the terminal tax, a license tax, also known as a distributor tax, a receipt tax, and a retail tax. The third and fourth options there, the receipt tax and retail tax, are extremely rare. Together, rack tax and license tax makes over about 85% of the states. And so for today's discussion, we're going to take a closer look at those first two tax imposition points to give you a flavor. For the rack tax imposition, the important question that you'll want to ask yourself when you're doing a return or you're going into a new state and want to understand how things are taxed, the question you want to ask yourself is, where is our customer in that transaction? Are they buying from us above the rack or below the rack? And why that's important is, generally speaking, in a rack tax state or above the rack transactions, the states generally require you to acquire a license before you can buy and sell tax-free. And generally, it's called a supplier's license. And for below the rack transactions, since it's a rack tax, tax is imposed when you quote unquote break the rack, which means you use the rack and put the product into a truck or a rail car. Usually all of those transactions are going to be taxable regardless of our own license status or our customer's license status. So if you're in a rack state and you've got customers above the rack and customers below the rack, your general expectation is that you're looking to meet the tax-free sales requirements for above the rack, but for below the rack, you would expect all of those transactions to be taxable unless there is some special exemption or carve-out for that customer. And we're going to cover some examples that are common a little bit later in the presentation. While we're talking about the topic of rack tax, there are two concepts that are unique to rack tax, and those are the destination state tax clause and having tax-paid purchases. For destination state tax clause, what that basically means is if you've got a transaction that starts in a state and it's being exported into another state, the many rack tax states have this clause that basically requires you to collect and sometimes prove that you've collected the tax in the destination state as a requirement for exempting their tax. And so if I'm exporting product from Texas to Louisiana, Texas, in order for me to report a tax-free export on the Texas return, I've got to collect Louisiana destination state tax, report it to Louisiana, and I have to do both of those things to meet that requirement. And really the reason that they do that is to try to prevent tax evasion, so that you're not representing to the state, oh, hey, I'm exporting my product, don't tax me. And that's fine, but you've got to follow some of those requirements there. The second concept that you see in rack tax states is having tax-paid purchases. This means if you're buying, if you're in the distribution chain, if you're a distributor or wholesaler, and you're buying product at the terminal from other suppliers via truck or rail car, and you're in a rack tax state, then you would expect that supplier to collect tax from you on the purchase. And when you subsequently sell and deliver that product, you'll need to then collect that tax in a subsequent transaction. And that's what helps you recover what you pay to the vendor. And if you track that appropriately, you should net to zero. And it'll be a wash. Again, going back to this pass-through concept, it should have no impact to your bottom line. For federal and approximately 40% of the states use this imposition point, so it's quite a few states. Moving on to the second common imposition point is the license tax, or also known as the distributor tax. Now, whereas for rack tax, we want to ask, where is our customer in the transaction? There's a different question we want to ask for license tax purposes, and that's to whom is the product being sold. Generally speaking, if our customer is licensed, then that transaction, your expectation should be that transaction is tax-free. and that typically requires a distributor's license in the state. Although some states may have a slightly different name for that license type. So unlike the rack tax, where our customer is in a transaction in a license state typically does not impact the taxability of that transaction. One exception to that is there are some license tax states out there that are surrounded by states who use a rack tax imposition point. And you may remember from the previous slide, the rack tax states are going to impose that destination state clause most of the time. And so if you find yourself doing business in a state that does use a license tax, but you have a lot of imports into that state, there's a good chance that you're actually going to end up paying tax even though you've got licensed customers, but it's because of that origin state that's imposing that tax basically as a requirement for you to exempt the origin state. So that's just a little caveat out there. There are some states, like I said, are surrounded by rack tax states, and so it looks a little bit different, or you might be questioning why would there be tax on the return. And 45% of states uses imposition points. So that's how I got to the 85% number from earlier. So if you have a base understanding in rack tax and license tax, it's going to give you a really good foundation for how motor fuels taxes are imposed throughout most of the country. So why are there 4 ways to tax? Right? There was the rack tax, license tax, receipt tax, and the retail tax. And practically speaking, it's because each of those jurisdictions have their own legislative body that passes their own motor fuels tax laws. At the state level, they're independent from federal, and so they all have their own rules and regulations that we've got to review and make sure that we comply with them. And they all there's all a different flavor to each of them, even though it's selected for the same reason, but they're all just a little bit different. A little bit of background, a lot of jurisdictions have moved from a license tax to a rack tax system over the last 10 to 15 years or so. So in those states where you might have returns that historically speaking you sell all to licensed customers, but now you've got this rack tax concept, whereas if it's in a truck or a rail car, you've got to collect that tax and remit it. So that was a big change. And there are some practical reasons why the jurisdictions have done that. If you think about it, it reduces the number of taxpayers that are remitting tax, because it basically pushes that tax remittance point towards the terminal. And there you're going to have your larger oil and gas companies that have product stored at these terminal facilities. And so that's just on a practical level, that reduces the number of audits that the jurisdictions have to conduct to make sure that they're getting their tax dollars. And I shared earlier, in the rack tax system, there's often this destination state tax clause that reduces tax evasion. So each state's laws, just to further reiterate that, each state that you go into to do business are going to have laws that affect what imposition points are used for motor fuels tax purposes, for inspection fees, for environmental fees, and the imposition point can actually be different even within the same state, depending on what product you're dealing with. Again, thinking about those different levels of complexity. And we're going to look at Utah's taxing structure as an example of this added complexity, even when you're within the same state. So on the screen here, you see 4 bullets for Utah gas, Utah jet, we've got Utah diesel, Utah environmental fee, and federal excise tax. So for the first example, for Utah gasoline and Utah jet fuel purposes, these products are taxed based on a license tax. And so it depends on what our customer's license status is or lack thereof to determine if you've got to charge motor fuels tax. Diesel is taxed at the rack, and so when you're removing product into a truck or rail car, that's when the diesel tax is imposed. For Utah's environmental fee, they are dependent on the first import or first sale to determine when taxes is due. So just within Utah, you'll see there that they hit essentially 3 of the 4 ways to tax. And what's really interesting is all 4 of those tax types, so I'm calling it gas, jet, diesel, and environmental fee, are all calculated and remitted on the same return to the state. So for every transaction that occurs in the country, if it's in a truck or rail car, there's also the federal excise tax impact there. To just give you, Utah is an exception where there is that much complexity. I would say in most states you normally see, the same basis, but it can be complex and utilize multiple ways to tax there. So what does this mean for you guys? What's important here is to determine the tax imposition point for whichever state you're doing business in, and recommend that you look back to their statutes or their laws, regulations, or other guidance to see which imposition point that's being used. There are other resources here that are listed that you may find information at the FTA, for the Federal Highway Administration, and the American Petroleum Institute with their websites here. They pull together surveys, tax rate information, so that's some helpful information, especially if you're going to new state, to give you a flavor of what's there. While the websites above and give you those summary tools, it's just a reminder that at the end of the day, the definitive source for any guidance that you want to use in the state is really going back to their statutes and their law. That's going to be your most authoritative guidance. What if product goes to another state? Determining tax imposition, when you're moving, now you're basically dealing with 2 states, and it's important that you look at both the origin state's laws and requirements, and also at the destination state's laws and requirements. And one thing I want to point out to you here is what sometimes we hear is the title transfer point. So if title transfers to you at the origin, and so you don't no longer own that product as it moves across state line, sometimes the initial gut instinct to that is to basically remove yourself from the transaction and saying, okay, I'm not going to be taxed in that destination state because I don't own product there. And while that is kind of a common sense evaluation, I want to point out that there are some states where you may still have a responsibility, or your customer may have a responsibility. It really just depends on the state and depends on the license class that they have. And so the takeaway there is, always look at both states when you have cross-border transactions to see how they treat those transactions specifically, and don't remove yourself from the transaction even though you don't have title in that other state. That's probably a good first initial evaluation, but again, just make sure that you're in line with what their actual requirements are based on your license type or the customer or the vendor's license type. So some questions to ask yourself there to close out the loop on this issue is your customer the importer of record into the destination state? Are you the importer of record? Again, how is that defined in your data? How is that explained in their rules and regulations? Well, up until this point, we now understand the 3 main categories of motor fuels tax. We know that there are 4 ways to tax, or the 4 tax imposition points. Now let's take it to the next step and talk about what types of products are taxed under those tax impositions. Products that are taxed typically include your gasoline, diesel, and jet fuel. Those are more common refined products that you see that most of us have a general understanding and know that they are taxed. However, the taxable product definitions in each jurisdiction, they all have a little bit of nuance to them. And so it's important to see, again, depending on what state you're in, the products that you're buying and selling, you'll want to compare that and your understanding of the physical characteristics of those products and their capabilities. How does that compare to the specific definitions that are in the state statutes? A couple of nuances you see that can make this determination a challenge is we often see this phrase used suitable for use or capable of use. And so it's important to really either have the internal knowledge or some sort of resource that can help you review the definitions, especially if you're dealing with blend stocks or some of the other less common products that are petroleum-based. That can be really tricky in applying these taxable fuel definitions. And another nuance that you may see in the definitions is when they refer to, is it liquid at a certain temperature or not? So this is where product spec sheets are important, or you may need a contact. If you're at a refinery, you may need a chemist there or petroleum engineer that's on site to help you make some of these decisions. But really, regardless of what you're calling the product on an invoice or on a contract, really it's the properties of the product that we need to look at and compare back to what's in the definition to determine if there's tax. In general, the taxable fuel definitions vary by state. Some states impose tax on gasoline. Some states impose tax on motor fuel. So they're all a little bit different. And we're going to illustrate this a little bit more looking at the motor fuel definitions for 3 states, for Utah, California, and New York. So here are the definitions for motor fuel in these 3 states. And these definitions are as of this week that you can see in their statute. And they don't change too often, but every now and then if they're in Congress, if they've got a new bill and there's some movement there, you may see some updates to their statute, including definitions. But I want to leave them on the screen there for you just to skim through really quickly for these 3 states. And then we're going to look at these definitions to determine whether 2 products are taxable as motor fuel in each of these 3 states. The first example we'll ask is going to be gasoline. Is gasoline taxed as a motor fuel in Utah, California, and New York? It's intentionally an easy question, as you'll probably see in the first line of each definition. It specifically calls out or includes fuel that is sold as gasoline. The second says motor vehicle fuel means gasoline. Motor fuel means gasoline for New York. So gasoline is a slam dunk, but you probably knew that before we even showed you the definitions here. Now the next one I want us to walk through is ethanol, which is a corn-based product that does not come from petroleum, right? But that is blended with gasoline often to meet the renewable fuel standards. So if we look through each of these definitions, can we tell whether ethanol is taxed as a motor fuel or not? For the Utah definitions, it calls out specific products that are gasoline, gasohol, and is used for any purpose, and it does include one exclusion for aviation fuel. So looking at the letter of the law here, it does not appear that ethanol is included in this definition of motor fuel. So that would be your gut feel there. For California motor fuel, again, it says it means gasoline or aviation gasoline, but the next sentence gives you a list of exclusions. And here, it does not include, and the second to last term, it does not include alcohol, which is synonymous with ethanol in our case. So California specifically carves out alcohol or ethanol for purposes of imposing the motor vehicle fuel tax. For New York, a little bit different here, where motor fuel means, if you look toward the middle of the second line, it calls out fuel-grade ethanol. It includes some ASTM standards. But generally speaking, the New York definition actually includes ethanol as a taxable product. That gives you a flavor for how detailed the definitions can be or how broad they can be. And the fact that some include exclusions, which are just as important on what called out to be included in that definition. And so you multiply this by roughly 50 jurisdictions and potentially different product types, and this is a big part of the complexity that's involved to make sure that we know what product we're buying and selling, and depending on what state we're in, we have a really good grasp on what that state defines as a taxable fuel. One thing I want to mention about the products is that the federal and state statutes, they each have their own taxable product definition. We just reviewed 3 examples. For reporting purposes, the states will generally have their own product codes that you can use to report those transactions on the return. One thing to point out here is the Federation of Tax Administrators, or the FTA, which is an organization that represents the 50 states, and they collect and publish tax administration information, including best practices, common schedule codes, these common product codes. They do have a list of standard tax product codes that some states either model after completely or just partially. And so there is some complexity there to make sure you use the right code for the products that you buy and sell in a certain state. And usually a good place to start there would be to pull the blank return and schedule pages and instructions from the state's websites. So now we move into, we covered the tax types at the beginning. We talked about tax imposition points. We've gone through some examples of taxable products and how the definitions are really important at the different states. Now let's look at who is charged the tax, or some common examples of when it's exempt. So for federal governments, sales to U.S. government entities are usually exempt from motor fuels tax. And at the state and local level, usually there are also provisions in the state's laws to exempt tax to those entities as well. However, there are usually very specific requirements for every state, and they can be broad, like refer to sales to any political subdivision of a state or local government is exempt. So that's very broad and include, you can cast that net pretty wide. But it can also be very specific, like specific independent school districts or a police department, a fire department, a public utility company, an electricity company, a railroad company. So that really gives you an idea of how many different types of exemptions there are out there. And going back to what we said earlier, each state or local jurisdiction has its own legislative body that writes its statutes, and they're going to cater that to what their community needs. A couple of other exemptions that we see, and one of the most common is going to be dyed diesel that's used for off-road use. Dyed diesel is chemically the same product as clear diesel that you get from a refinery, from a terminal. The dye there is really red food coloring, if you will, for discussion's sake, that's added to the fuel to make it pink, so that when someone is trying to cheat tax and they're buying dyed diesel and not paying the tax on it, but then are using it on a diesel pickup truck and are driving on the highway, and they get to an inspection station, the authorities can basically pull a sample from the fuel supply tank, and they better not see any pink fuel that comes out of there. If not, there are some, you can lose your truck, you can have to pay a fine. That's really why it's dyed there as a marker to be used for enforcement purposes. But chemically speaking, it's the same fuel. Off-highway use of clear taxable fuel, this is where the product that's being pulled from a terminal, from a refinery, it's clear diesel fuel, and so it's going to be taxable if you're in a RAC state. But ultimately, that fuel gets to an end user who's going to be using that fuel off highway. Well, since the motor fuels tax is imposed to repair roads and highways, generally, you should be able to find an exemption or a refund mechanism, but because it's clear fuel, there's a very good chance that that obligation is going to fall to the actual end user to pursue that refund with the jurisdiction. And it's usually because since they're using it, they can actually prove or offer some sort of evidence or affidavit to the state to certify that they have used the fuel. Whereas if you're just a distributor, it's harder for you to prove that to the state. So what if my customer is not using the fuel on the road? So that kind of goes back to what we were just saying here. It's our responsibility to figure out if you've got a customer that tells you they're using the fuel for an exempt purpose, that we review the statutes in that state and understand, where the imposition occurs and who has the ability to claim that credit or refund. Sometimes we'll be able to go ahead and report an exempt sale on our return and not have to collect the tax from the customer at all. Sometimes we're going to have to report the transaction as taxable. We're going to have to remit tax to the state, and then we have to then go back and ask for it in the form of a credit or a refund. So that really can go in a number of different ways, depending on how that state, has written their rules around exempt use. For example, using fuel off of the road. And anytime we're dealing with exemptions, it's important to understand what are the state's requirements to make sure, what we call perfect the exemption, meaning have we followed all of the requirements? Have we collected all the license copies or certificates or forms of some sort so that under audit, we can very confidently show that we've followed all the requirements. And generally speaking, we follow the piece of paper rule for perfecting an exemption. And generally, is it an affidavit that you get from the customer that is a signed statement saying they're going to use the product for this purpose? Is it an exemption certificate that the state issues that you need to populate and get signed by all parties that are involved? Or is it just verifying that the customer has a license that's specifically required? And they can give you a copy of that license. Some states offer an online list that you can pull to check licenses as well. So here, another question, what if my customer, or I have a copy of a license, aren't they exempt? And the answer is not necessarily. An entity may hold several different licenses, even within the same state, even for motor fuels tax purposes. There are several different designations in various states depending on what kind of activity you do, what kind of products you deal with. And so when a customer provides a copy of their license, we'll need to evaluate, what kind of transaction do we actually have here? What does the statute say, how tax is imposed? And if it's exempt, what are they asking me specifically? And is what my customer is providing, is that actually is it relevant to the transaction at hand? For example, a sales tax exemption is generally not going to qualify for the customer for any motor fuels tax exemption. It's a separate tax type and can be administered by a different office. So that would not, quote unquote, perfect our exemption. But in terms of setting up customers, that's a very common certificate that's included in the customer credit application or file, and so we'll see that sometimes, and there's some misunderstanding about exempting from motor fuels tax purposes. So we just talked about some common exemptions. Now let's look at general licensing requirements for motor fuels tax purposes. And we'll look at this for state and then for federal as well. Generally speaking, every customer needs a license for any state that they're doing business in. So they're buying or selling product in the state, there's a good chance you need a license. And so that would cover importing, exporting, or even selling just within the state, either below or above the rack. It could be any of those scenarios, depending on the tax imposition and where the transaction is conducted. that license may or may not grant an exemption. For federal purposes, generally speaking, if you're considered buying and selling taxable fuel in a pipeline or in tank, what we call within the bulk transfer terminal system, you're likely going to need what's called activity letter S as in Sam on the Form 637 registration. Outside of those above the rack transactions, your expectation is that all taxable product removed at a rack is going to be taxable. And if that's all you're doing, buying and selling below the rack, and you expect the transaction to be taxable, generally that doesn't require a license at the federal level. However, on that same Form 637, there are a whole host of other letters on there that are required for very specific refund opportunities or if you do very specific activities. They are rare for needing them, but you can pull that on you can Google IRS Form 637, just a couple of pages, and you can read through what those different letters and a brief description of what they are. The biggest takeaway here for federal purposes is if you're considering buying and selling fuel within the bulk system, it can take up to 8 to 12 weeks to receive an effective valid registration. And you need a valid registration before operating to avoid a pretty significant failure to register penalty. And so it's important here to educate your marketing teams, your operations team, so that they understand that there's a pretty big penalty exposure and to make sure we give the tax team enough time to identify and apply for the appropriate registration. In motor fuels tax, each entity with a separate FEIN is required to be licensed at the state or federal level, depending on your activity. So we not only need to make sure we are selling to our customer's correct legal entity who is licensed, if a license is required for that transaction, but really we need to apply the same care to our own licenses. If we have a more complex org chart of entities, we need to make sure we are licensed appropriately. The concept of a disregarded entity from the income tax world does not apply in motor fuels tax. We are FEIN driven, and that's really, really important. And also note that you may have other tax or business-related registrations, like a sales tax registration or a Secretary of State registration that may be needed in addition to the motor fuels tax license itself. The last topic I want to cover with you today is generally reporting. And there are 2 steps when it comes to reporting. You got to make a tax decision on whether a transaction is taxable or tax-free, and then we need to determine if we have to report that transaction. I shared earlier that for the most part, if you have a license in a state for motor fuels tax purposes, then there's a good chance there's a monthly return that goes along with having that license. And even if you have 0 transactions, once your license is effective, the requirement is that you're going to file, even if it's a 0 activity return, that you've got to file monthly returns to be compliant with your license. So what are the data requirements for that first step? And that's tax decision. At times, additional information is needed, but at a minimum, we would need the following data elements. And some of these should look familiar to you. We've referred to them throughout the presentation. We got to know where the transaction occurred, origin, destination, what was used to transport the product itself, who is our vendor or customer. We need to understand the FOB terms of the transaction so that we know where did title transfer, was it at the origin, was it at the destination, what type of origin or destination, meaning what kind of facility were we in, was it an IRS terminal, a refinery, or a bulk storage plant that's not part of an IRS terminal? What is the transaction itself? Is it just a buy-sell? Is there some exchange related? When you move to step 2 for tax reporting purposes, you're going to need some additional pieces of information. motor fuels tax is transaction level reporting, and some states even require full inventory reporting, including gain-loss numbers. In many cases, especially the states that impose direct tax, you are essentially sending individual line item detail for every taxable truckload that leaves your facility. So that can, depending on where you're conducting that transaction, can be a pretty large volume. So the additional fields that we need for reporting, is date information that comes from the BOL. You need the BOL with the manifest number. We'll need volumes, net, gross. That comes off of the bill of lading. And then the billed quantity is one of those two, but what's contractually defined there. Each state may have different requirements, and that's also important for you as you go into a new state to understand what they require for reporting and invoicing purposes. You'll need to know the carrier's name and FEIN. That's usually a required field on the returns. And then position holder and IRS terminal control number. For position holder, this concept is important, especially in rack tax states. The position holder is essentially the inventory holder in a terminal who has a storage and terminaling agreement with that operator. And so they're recognized on the books and records of that terminal operator. And that concept is important, again, in many rack tax states, since they're usually defined as the party that's liable to the state to collect and remit the motor fuels tax. And that field is sometimes required for reporting. One thing I noted here is even if a transaction is not taxable, it may be reportable. And so on the state that you're doing business in and filing a return, the first place to start there is usually looking at the available schedule codes and the descriptions that are provided in the instructions or as part of the schedule description to get a feel for, can you tell based on the available information, is the transaction reportable or not, even though there's not a tax impact. And if you're not able to tell from that, then one option is to contact the state and see if they've got any policies that they can share with you, by phone or by email. So we talked a little bit about motor fuels tax returns just now. They're usually due monthly. For federal purposes, they are due quarterly with deposits that are due roughly every 15 days. In addition to these motor fuels tax returns, there are some information returns, and these are filed by pipeline carriers and terminal operators. These information returns don't have tax due on them. They're really intended as a cross-checking tool for the states, so that in a state, again, going back to especially rack tax states, they can track or start with the terminal operator's report on all of the truck removals and compare that data to the suppliers that are basically selling product out of those terminals. And that's one of the cross-checks that states can use to make sure that their taxpayers are compliant. To close out this section, each state issues guidance on various accepted return filing and tax payment methods. Generally, for return purposes, you either file them electronically or printing old-fashioned return face page and schedules and signing them and mailing them off. For electronic or e-filing, there are a variety of options or requirements out there depending on the state. You might hear of the term EDI, XML, or an Excel template. So depending on what the requirements are, you may need to look into some sort of software package. Like Avalara, for instance, they're able to create returns using a number of different electronic files for you there. Some states have, let you choose basically. They provide EDI, XML, and Excel, and you pick the one that you want to use, whereas some, force you to use a very specific type. So that'll drive, what your options are in terms of software. For payment methods, generally speaking, it's almost everything except sending in cash to them. So you got ACH credit, ACH debit, check payments, sometimes for wire. Some states may limit the choices that you have for payment methods. based on your volume of transactions or how much tax you pay. So if you've got high liability in a state, they may move you from some sort of wire or ACH, so that's electronic rather than sending in a check. So again, look at the state that you're in and go from there. So we're getting towards the end of our presentation. Just to recap there, we talked about the general concepts and complexity today. We have motor fuels tax types. We talked about the different ways to tax. We talked about taxable products and how it's important to look at the specific definition in each state that you're in. Even if you sell the same product in 5 different states, they each have their own nuances that you'll want to make sure you follow. And then we talked about a little bit about exemption, licensing, and reporting. At the end here, I've included just a few resources for you. The first is the state website. They normally have some sort of link out there that provides forms, publications, FAQs. That's a good starting point for you if you're trying to see if they've got any helpful information. We have a sister company called MotorU LLC for Motor Fuels Tax University that provides training, and we offer a free page called the Resources where we've gathered a lot of the links that are publicly available that we actually use on a day-to-day basis in our own work and have made that tool available for free to the industry. So you're welcome to check that out as a bookmarked page, if you will, and it allows you can click on which state or jurisdiction you're working on to jump over to those resources. This presentation is an abbreviated version of a full version of an on-demand course that we offer as well, in case you are interested. Lastly, we've got a link here for you. Earlier I mentioned if you've got questions, you may need to call the state for guidance. And the FTA provides a list of contacts on their website that you can click through here and get to the person that handles motor fuels taxes for that state. And for now, Tom, I think we've got a few minutes for questions.
Yes, we do. Thanks, Johnny, for that very informative presentation. Our first question is, are all motor fuel sales in Michigan, gas and amp, diesel, on-road, diesel off-road, subject to state environmental fee of 1 cent? So it's are all motor fuel sales in Michigan, gas, diesel on-road, diesel off-road, subject to state environmental fee of 1 cent?
So I don't have that that specific state top of mind, but in general, if you've got on-road, if you're selling fuel, the assumption that it's going to be used on-road, especially if you're selling gasoline and special fuel or diesel. And so for the on-road portion, I think the expectation is that you're going to be subject to the fee. As far as off-road use for the environmental fee, that's a little bit tricky. I don't have that answer top of mind, unfortunately, but for inspection fee purposes, usually that's for product quality, for inspection. So dyed product is actually usually, off-road product is usually included in that basis. So my expectation is that you would be subject to it unless you found specific guidance. I don't know, that wasn't a specific answer, but that's my gut feeling there.
Okay, great. Second question we have is, what is the difference between the gasoline and gasohol? They're asking for the difference between gasoline and gasohol.
Sure, great question. So for gasoline, that's, I'll call it 100% gasoline in the ingredients, whereas gasohol is a term that means you have a blended product of gasoline and some portion of ethanol in there. And so when you pump gas, depending on where you are in the country, many gas stations offer a blend called gasohol or E10, which means it has 90% gasoline and 10% ethanol. And so, again, depending on where you're in the country, the next time you go to the gas station, take a look at the pump handle. Usually the labels will say this product contains up to 10% ethanol. So, again, in general, gasohol is a blend of gasoline and ethanol. And E10 is probably the most common blend that we see.
Okay, great. And then our last fuel tax question is there a priority? In other words, what is the highest level of proof between a license or an affidavit? What serves as a higher level of proof?
So from a licensing, so I kind of see that as two different things. The license evaluation, that's a pretty factual point of data. Either you are licensed or you're not licensed, and you typically get like a piece of paper from the state. So that's factual. An affidavit usually comes in when it's not as clear. There's not some piece of paper that gives you the information you need. It's more so that you're basically affirming that I am using this fuel off-road, right? There's really no piece of paper that's going to give you that otherwise, other than your, attesting on that document saying I'm doing this, and if you're going to get taxed on this afterwards, come and tax me on it, basically, or collect a tax from me if you get in trouble for this. So I see those as two different forms of document depending on your needs.
Okay, great. And then the last question is a non-fuel question. It's more of a webinar question. We've received 3 or 4 requests for the slide presentation, which I will be happy to send out upon request in PDF format after this webinar. So thanks for your interest, and you obviously hit a home run with your slides, Johnny. People want them badly.
Oh, great. Well, thank you, Tom, and thank you for everyone for your time today, too. I really appreciate it.
Great. And if anyone has any additional questions regarding this presentation, please feel free to reach out to Johnny directly. And if you have any questions regarding Avalara excise products, please reach out to your account manager or email us at customer.loyalty@avalara.com, and we'll be happy to get those questions answered for you. At this time, since we have our excise customers online, I feel it necessary to promote our biggest customer event of the year, and that is Crush DC, which takes place May 9th to 11th in Washington, D.C. at the JW Marriott. We have a very special educational track for our excise customers. We have 18 sessions. Each session is worth 1.5 CPE credits, and it covers everything from the Avalara Exercise Roadmap to thought leadership sessions on energy tax trends in 2018 to environmental reporting requirements for fuel suppliers. It runs the gamut. And if you're new to Avalara, we also have a learning lab where you can get one-on-one coaching to solve any type of integration issues or any type of questions you may have in operating any of our excise products. One-on-one training, and we can access your excise accounts directly from our location there in Washington, D.C. So we're not working with dummy accounts. With that said, I also want to extend a big thank you to Johnny for presenting to us this afternoon. And I want to thank all of you attendees for taking the time to tune in. We look forward to getting together for another excise webinar real soon, and we hope to see you at Crush DC in May. Thank you so much, and have a great day.